Okay, welcome to episode 2. Happy to have you here with us. What are we talking about today? Let's take a look. Okay, Trump has taken over the real estate news cycle once again, actually taken over the total news cycle, but he's starting with real estate. And he has signed his executive order banning institutional investors from real estate. We're going to dive in. Does this even matter? Number two, we want to look at how does this affect the Treasure Valley? Do we have institutional investors here? How many homes do they have? What percentage is that of our total inventory stock? And are they driving prices up for us? Number three, talking about mortgage rates, what's going on with that, because they did pop this week. And then my favorite section, always, the BS real estate headline of the week. So I want to check one thing over here, get this set up. Okay, so, oh, sorry, I had to redo this because I made a mistake at the end and I can't use those. So here's where we're going. So we want to talk about the first part, which is the national story. And here is a fact sheet from the White House. Imagine that. So they want to talk about the data points that are in the executive order and what they mean. So this is President Donald J. Trump stops Wall Street from competing with Main Street homebuyers. Yeah, well, you know, that headline's our BS story of the week. How about that? It's not, but I should have used it. So, because that, and again, not being political, I'm always talking about real estate, the real part of real estate. It is what it is. I don't care who said it. I don't care whether I like them or hate them. I'm going to tell you what I think and what Kirsten thinks about this. And this is a BS real estate headline. But here we are. Let's dive into it. So, stopping Wall Street from competing with Main Street homebuyers. That's the main thing. So, this is the one thing. There's two things. These first two sections right here are the only two things that can be fully executed. It's not a constitutional issue. It's easy to fix, but the reality is we're talking difference without distinction. This is not how institutional investors fund or acquire the properties, and they haven't done scatter site buys. And scatter site buys are when the institutional investors are actually competing with you and me, me being your realtor, or Kirsten being your realtor, you being the buyer, seller, or investor of real estate that's open on the market. It's on listed in the MLS, something that any of us could go actively buy or sell. So that's not how they do it. They do it with Wall Street money, they do it with venture cap money, they do it with their own money. They're not using Fannie and Freddie to buy them as a rule. There might be some smaller, home investors that do that. I don't think so though. All right. So the two things they're talking about, federal programs can't help the institutionals. Great. Nobody cares. It's like Jurassic Park when the guy's selling that shaving cream can full of dinosaur embryos and he's trying to be all on the down low and spy like. And the heavyset guy with the glasses and the Hawaiian shirt says, he's got stuff, see? And he looks at the guy and says, see, nobody cares. That's pretty much how it is. The institutional investors are looking at that and they're going, I don't care. So that's where we're at on that. The second part is which again they can execute and is a good idea. They're instructing key agencies, which are going to be HUD, FHA, Federal Housing Administration, and Housing and Urban Development. They're going to focus Treasury and the GSEs like Fannie Mae and Freddie Mac. Focus on individual owner occupants through first look policies to give them a leg up over investors and institutionals. So those can be affected, those can be done. It won't affect the big like the Black Rocks, the Invitation Homes, those guys, they're yawning. They don't care. Where this will affect is if you want to buy, if you're a small mom and pop and you don't own any investment properties, you want to go buy an investment property, it's going to become more expensive now. That is going to this what I'm looking at right here, the second bullet point. That's going to make it more expensive in that if the GSEs are not going to buy investor owned paper, when I say investor non owner occupied paper, that's a problem because you can do conforming loans now that can be an investor property. You're going to pay anywhere between 50 and 75 basis points more for the interest rate, but the government guys will still buy that. If they're going to not buy that or put quotas on it or whatever, that will increase that spread between the owner occupied rate and the non-owner occupied rate. How much I don't know, but it will make it expensive. Just like on a side note, if they cap interest rates on credit cards at 10%, you're going to see everybody with a FICO under 720 start losing access to credit. Seriously, I mean, they do it because it's profitable. Do I want to see them make 35 points on a credit card? Hell no. That's literally out of control. Thank you, Dodd-Frank Act. That's where that came from. That's where they lifted all the limits on that because all the banks and the institutions said, we have to make money back. We just lost so much money. You have to ask them how they lost that money through stupid lending policies. God, don't get me started. Anyway, so these 2 points are probably the only 2 things of this entire thing where they're going to be able to do anything. Is it going to fix housing? No. So, how are the institutional investors going to react to this? They're going to go strictly to build to rent because, believe it or not, the build to rent, I don't know if they talk about it in this page from the White House. Uh, Yeah, I didn't read this whole thing in detail because most of it's fluff that's not 100% accurate. So let's go on to the next part I wanted to talk about. Build to rent is exempt from the White House order banning institutional investors. Now, I'll talk a second as a guy who used to own, I say a guy, Kirsten and I owned a property management company in the Los Angeles market for 15 years, managed a lot of doors. I can tell you, as somebody who's done it professionally, if I could design, build, furnish an entire build to rent community, I'd be in heaven as a rental landlord investor. Because let's talk about business for a second. And I'm a student of business. Kirsten is too. I mean, our oldest company right now is 30 years old, outside of real estate that we've owned nonstop. Southwest Airlines is one of my favorite business stories. I can't remember, Herb Keller, I think, was his name, the president. He had very clear business goals, and he understood systems and models more than most. The reason that Southwest was so profitable, they were for years and years, actually for decades, Southwest Airlines was the most profitable airline in the country because they had a couple of rules, just like Warren Buffett had a couple of rules that were core principles they didn't deviate from. And the three big ones that Southwest just excelled at, they were just spectacular in their execution of that, was the economies of scale and staying their lane and managing inventory. So, they weren't a retailer. So when I say managing inventory, that sounds strange, but basically they had one airframe, the 737. That was it. So all of their A&Ps, their aircraft and power plant mechanics, only needed to know one airframe. That's great. They stayed with one or two, maybe three variations of engines, but primarily one or two types of engines. So again, their A&Ps only needed to know their way around two different engines in detail. So if something broke, they pulled it off the shelf. They're not, you look at Delta or American or United, they have an entire fleet of mixed airframes. And because of that, they have to stock a bunch of different engines, a million spare parts, all that costs money. So Southwest was really good about airframes, engines, just one choice airframe, couple choices of engines. And their other thing they did, they always bought fuel futures way in the, like years ahead sometimes. As far as they could buy them, they'd buy them and sit them on. So if there was any kind of disruption in fuel, especially when Venezuela went offline 20 years ago, fuel prices jumped. They used to be $20 a barrel for a barrel of oil, and at one point they were $120 a barrel. But if they had 2 or 3 years of futures locked up, they're still paying $20 a barrel. So that makes a difference when you're paying $1 a gallon for avgas. Let's say $5 a gallon for avgas when everybody else is paying $25 for avgas. Your tickets can be cheaper. You can gain more market share. So, in a nutshell, that's how Southwest did it. They're not like that anymore. They still fly 737s, but you know they've gone off the rails since Herb's gone. So, it is what it is. But from a build to rent standpoint, sorry for that long side note, but I just want to give you where I would go if I were one of these institutional guys. I would design, let's keep it in Treasure Valley context. I would design a small version of Spur Wing with a golf course, small golf course, probably 9 hole. I would do a scaled down version of Legacy. I would do a development very similar to Heritage Commons over in Northwest Meridian. They got a great park, they got a great their clubhouse. They've got a big pool, they've got a weight room, they've got a big meeting area they can use. They've got a Ford, it includes their pressurized irrigation. It's a great community. We love it down there. That's what I would do. I would design these communities literally from the ground. I design a very efficient sewer system with cleanouts everywhere, easy access for everything. I would design the homes with the flow. I would design them with maintenance in mind. I would buy all the same packages. There might be a couple different levels. The higher end white collar executive rental. The white and the blue collar rental. They would be similar in size, similar in flow, similar in trim, but different appliance packages. But saying that, all the executive levels would have the exact same package in all of them for appliances and systems like your heating, cooling, all those things. And same thing on the blue collar side, and I'm just using those price points differentials. That way, from maintenance, I could have a very small crew, very well trained, say everything was Frigidaire as far as the appliances, or I say Frigidaire, Samsung, whatever. So they only need to really know one brand. I can stockpile a ton of parts of the same thing that I can use in all these houses. I'd buy the same HVAC systems, so they only need to know one HVAC system, water heaters, tankless water heaters, whatever. But the scale of economy on the buys side, for acquiring all those things would be cheaper because I could buy a much bigger buy, which would give me a lower price per unit cost. Maintenance would be far lower because I'm back stocking more or less, fewer parts or fewer variations on the parts. How about that? Control units, compressors, uh, you know, ice makers. I'm just pulling things out of the air here. But everything, if you do that, where you're designing it with maintenance in mind, with you're building it as 100-year rental community. It's not going to change. The benefits are that the tenants, the other thing I would say, I would put them in markets where affordability is an issue. I would go in, Los Angeles, San Francisco, uh, Atlanta's really not that big. Even Idaho, here in the Treasure Valley, it's expensive, and a lot of people can't buy a house here. Treasure Valley is definitely a candidate. But I build these long-term master plan communities that were built to rent, and I would do it. I'd make them really nice within reason, so that tenants would have something. I mean, a whole class of tenant would actually be able to benefit from a master plan community, which is not always the case. Sometimes, you can get a rental in Spur Wing, Heritage Common, or Legacy or something like that. I mean, I know you can, not sometimes, but for the entire community to be like that, that's kind of cool because especially here in Idaho, there is a economic cap on rents. It's not done by the government or anything like that. It's just there's only so much you can get for rent, no matter how nice the house is. I mean, you take some of the houses that are getting $3,500 a month here, you move them to a Los Angeles or Bay Area, you're talking a factor of 3 or 4 that you would get down there. It just doesn't get supported here. So even if you built a nice community, the rents wouldn't be $5,000 or $6,000 a month. So it, in some ways, especially for the tenant class, that would be a good thing if more master planned rental communities were built because they'd get all the things. And if it was a big enough, it starts driving the schools. That's a good thing too. So I think it's good. And if you have more inventory coming online, that brings rents down. So it's disinflationary that way. So BTR is a great idea, I think, especially when you look at the demographics. I mean, Gen Y and Z together are bigger than the boomers are on a headcount basis. And the biggest cohort within those two generations turned 30 last year. So, you know, 30 is peak first time home buyer, first time family formation, all that stuff. And with affordability being what it is, the buy side has been pushed off on the first time home buyer side. So if you can rent a great house in a great community with great schools and great amenities for the kids and everything else, or yourself for that matter, that's a good thing. So all in all, the BTR side, I would like to see expansion on that because the economy is what it is, and if affordability is an issue, which it is, you introduce something into it that would actually make better quality rental units for the same price and a better overall quality of life for the tenants. That's a win across the board as far as I see it. So there you go. That's where BTR is exempt. You're going to see more BTR programs everywhere. We do have them here. Corey Barton with CBH has got a couple going up. And again, my take on it is the ban doesn't matter on anything, with the exception of the fact that it's going to focus the institutionals on build to rent. And that overall is a good thing, I think. So there you go. All right. So we've talked about that, and let's talk about how does that affect us in Treasure Valley. So we talked about actually I'll cover this one too. I'm sorry, this is going back to the last one we just talked about. So on this one, there we go. Invitation Homes bought ResiBuilt for $89 million. Now, that's not because of Trump talking about banning institutionals or the executive order he signed last night. This is something you can't put together an $89 million business deal in 2 weeks. It doesn't work like that. They've probably been talking to them for over a year now. I don't know how that Zoom happened, but I kind of like that. I got to learn how to do that. That's a hand gesture, I think. We'll see. Anyway, so Invitation Homes has bought ResiBuilt, and those guys, ResiBuilt delivered 4,200 homes in the last, what's that, 8 years. So that's Georgia, Florida, Carolina. So that's a Southeast Sunbelt company, which is great. And we'll see how they scale that. But you're going to definitely see more of these guys buying these BTRs, and that's where it's going. So let's talk about where they are. We've already talked about this in the last episode of our podcast. We went deep on this stuff, and I'm not going to do it again. But Sunbelt, basically all through here, and then Ohio Valley and the Central Midwest, a lot there. But let's talk about how does it affect us, because this is important. Let's see. Okay, so zoomed in on Southwest Idaho, and we're going to talk about Hawaii Canyon, Emmett. I'm sorry, Hawaii Canyon, Ada, Jim County with Emmett, Payette County with Weiser, and Boise County a little bit too, because although I don't think they have anything in Boise County, we'll see. So let's see. Hawaii County, shocker, they don't have any. Of course not. There's hardly anything in Hawaii County anyway, which is why I love Hawaii County. Those of you who know me with my Jeep, Kirsten and I like bouncing around all over the place exploring the Oahes because they are some of the most spectacular scenery you're ever going to see in your life. Honestly, you get down there, Sucker Creek, and on the backside of the Oahe, Sucker Creek and Leslie Gulch, it's like you feel like you're in the Lord of the Rings or something. It's spectacular. So, side note, you ever want to go out there, you're one of our clients, let me know. We'll go have fun. So, Oahe County, 0. So let's talk about Canyon County, because if you look at that, Canyon County has the darkest, color of all of Southwest Idaho, and they are saying that in Canyon County, the share of single-family homes (SFH stands for single-family homes) owned by large investors, and again, large investors in the context of this data is 100 or more homes owned by the investor. So they're saying they own 1.8% of the Canyon County housing stock. This could be our BS headline of the day, too, because that data is wrong. There's 1,383 homes is not 1.8% of the single family home count in Canyon County. So I'll come back to that. Next, Ada County, where we live. Ada County share of single family homes owned by large investors, 0.6%, because there's a lot more homes in Ada County than there's in Canyon. So 1,011 homes. So between the two, you got what, 2,394 homes. Say 2,400 homes. And they're saying between the two, that'll be 2.4% of those, of the total count of those homes, 2.4%. I'm calling BS. Well, actually, that's not accurate because I can't blend those two without blending the inventory. Anyway, they're saying that 6% of the homes in Canyon County is 1,000 homes. I'm sorry, 0.6%. And that 1.8% of the homes in Canyon County is 1,383. So let's talk about that for a second after we go take a look in Payette. Got 6 homes in Payette County. Jim County has 0. No shocker there. And Boise County, I'm shocked. They got 4 homes by large investors. That really does shock me. I mean, Boise County, Idaho City is the biggest thing there. Then there's a bunch of, rural homes, for lack of a better term. I kind of feel like a dog hearing a high-pitched whistle there. That there's 4 homes owned by large institutional investors in Boise County. I did not expect that. So there you have it. But overall, let's talk about this for a second. So 2,400 homes in Treasure Valley. Treasure Valley all over. I look at this all the time. I mean, I talk to the county assessors. I try to generate data that I can't, let me rephrase that. When I can't find data, then I start digging and start calling people and get the data for myself. So I do that a lot because we're seeing a lot of headlines now with saying we're over pandemic. We've reached pandemic level inventory. We're over pandemic inventory. Yeah, no shit. So, excuse me. we built a lot of homes here. I mean, for, for the love of God, in Canyon County, I mean, there's many, many months where 53, over 50% of the homes sold, the units sold for a month, are new construction builds. So, we built so much inventory that, of course, we're going to be over pre pandemic levels as homes come back on the market like they have. And we're coming off historic lows. I mean, 2022, good luck finding a house in the first quarter. I think that was the low water mark historically. Uh, but anyway, let's talk about how many homes we have in Treasure Valley. Sorry. Based on all the research I've done, I think 320 to 325,000 is a real number for all of Treasure Valley, starting on the west end of Canyon County, Weiser, going into Oregon, all the way over to the far east side of Boise, but not counting Mountain Home. So if you look at all of Treasure Valley, you know, 300 to 325 real number. So, 2,400 homes is not hardly anything. So they're not affecting us with this executive order. It's not going to do anything. So that is what it is. So let's jump back here and talk about, okay, rates. Rates are important right now because they've jumped again. Last week on our episode, they were 6.07, which was great. And the Friday before that, they were all the way down to 5.99. What drove that? It was another Trump. It wasn't an executive order. I think he just instructed the Treasury, which is part of the executive branch. He instructed them to have the GSEs, which Fannie Mae, Freddie Mac, all that, to buy $200 billion worth of MBS, mortgage-backed securities. So that shrunk the spread real quick. The spread being, and you're going to hear me use that word a lot, the spread is the difference between the 10-year Treasury note yield, Treasury bond, and the 30-year, the published going 30-year mortgage rate. So, today it's, we got to get to work today. So I'm sorry, I'm ahead of myself. So let's jump over here, back to the screen we were at. Today's mortgage rate, 6.2. All right. So the, like I said, last time it was 6.07 last week. This time it's 620. And if we jump up here to the 10-year Treasury note, it is up to 4.276. That's what the yield is. Now, what would make it jump 20 basis points? Some people say, well, we've got, we've got Trump's executive order on institutionals. We've got the whole Greenland and Denmark thing. Denmark just sold off $100 million worth of Treasury notes, and that's disrupted the market and driven up yields. That could be the BS headline of the week, too. I mean, you see the trend here. There's all kinds of bad headlines out there. And, on the topic of Denmark, I love Denmark. Kirsten was born and raised there. I mean, a lot of people don't know that, but yeah, she's Danish, born and bred. And we spent a lot of time. We honeymooned there when we got married 30 something years ago. We went there almost every year when her parents were alive. I love Copenhagen. I used to love Copenhagen. It's changed a lot since then. But so is London and everything else. I mean, Europe today is not the Europe of 20 years ago, but neither is America. So things change. It's one of the bad things about being old or getting older is you see enough stuff to where some of the things you really love change, and it's like, wow, okay, well, that's sad. But anyway, I digress. Sorry. Denmark selling off $100 million worth of Treasury notes. It doesn't matter. I mean, matter of fact, Treasury Secretary Best, I'm going to murder his name. I actually need to go learn how to pronounce his name right. But I'm a fanboy of his, believe it or not. He's the strongest Treasury Sec we've had in my memory, quite honestly. I mean, he's excellent at what he does. So, and that's not a blanket uh, endorsement of everybody and everything. It just is a Treasury Secretary. He gets it. He comes out of the business side. He understands the economy. He understands what levers actually make a difference, and he understands on how the things that he can do as Treasury Secretary to reduce our $37 trillion in debt and the advice he can give people to help affect that. So that part I like. But he made a comment today that really angered me. I understand the context. The context with which he was using it was accurate and correct, but somebody asked him at Davos about Denmark selling off the $100 million worth of Treasury notes as a retaliation for Trump's claims on Greenland. And he said, look, That sale is insignificant, just like Denmark's insignificant. And on the global stage, economically speaking, that's accurate, but it was meaner than it should have been. So, as somebody who loves Danish people, Denmark, and everything else, I hated seeing that. So, it is what it is. But that's not what moved the market for us. That is not what did. Uh, that's not what bumped the 20 basis points there. What happened is in the Japanese bond market, the prime minister over there, who is relatively new, she instituted some policies that the Japanese bond market hated. And what happened is there was a huge sell-off. Their yield on their 10-year jumped over 4%. And I don't remember the last time it jumped. I used to pay a lot of attention to the Japanese market, especially back in the 80s, because it was just a mess, a hot mess. And their real estate market was a hot mess, and it was bad. And it was like that for decades. And then they finally started getting stability, which was great. But they had a sell off last week. Or actually, what's today? Wednesday. It was either Friday or this Monday. She introduced the policies, and the bond market said, no, we don't like that. And they popped the yield up, and the sell off happened. And we've had spillover. Basically, that contagion has rolled over into the European markets, other Asian markets, and certainly our market. And that's what's jumped our rates up. So last week we were at 6.07. This week we're at 6.2. The next thing you'll see is a bunch of headlines saying, oh my God, buyer demand's cratering, all this other BS nonsense. And yes, last week was an anomaly. Between last week and the Friday prior rates dropped down to 5.99 when Trump instructed the GSEs to buy the $200 billion worth of mortgage-backed securities. So that introduced historic buyer demand overnight, and it went through all of last week with the low sixes. But now that it popped back up to 6.27, did we say? 6.2. 6.2, it's going to slow the demand down, but the doom guys and the crash bros will say, oh my God, buyer demand has collapsed. We're going to see the crash like 2008. You're not, all right? Just hang with me. We'll tell you the truth on all this crap, and it's not going to happen. So that's where we're at on rates. It is 6.2 right now. We'll see where it goes. I mean, the Japanese bond market will shake out. It's not going to crash over there. The nonsense with Denmark, Greenland, and all that stuff is going to slow down too. Supposedly, we're going to get some clarity on exactly what Trump's plan is on Greenland and Denmark and all the other fun stuff at Davos today. He was supposed to announce it. I haven't gone back to look see if he has yet or not. But if there is clarity on that, it is what it is. And just side note on Trump, this is how he negotiates. He makes outlandish first asks because he wants to get somewhere in the middle, and everybody their hair catches on fire. I mean, I don't have hair, but you know what I mean. Running around, oh my God, he said this, and then it comes back down, and then ultimately he'll usually wind up where he wanted to be. So you can't get mad at a dog for peeing on a fire hydrant. That's what dogs do. You can't get mad at him for making outrageous claims to start a negotiation because that's what he does. So, take it with a grain of salt and see what it shakes out, but don't, just let it play out some before making a decision one way or the other about how you feel about it. So that's that. So where are we going from here? We are going to the biggest real BS story of the week. And to be honest, there's a plethora to choose from. And there will be every week, to be honest. But today, the Trump story, the executive order banning him, that literally took over the news cycle. It's either Trump talking about Denmark and Greenland, or Trump talking about the banning the institutional investors. And most people are hooking on to the banning the institutional investors. And we're seeing all these stories. Trump fixed the housing market, or a bunch of videos. Did he fix the housing market, and all that fun stuff? So let's take a look at what we're seeing here today. Did Trump fix the housing market?
Did Donald Trump just solve the housing crisis? He posted to Truth Social that he is, quote, immediately taking the steps to ban large institutional investors from buying more single-family homes. And millions cheered. In 2024, individual and institutional investors made up a quarter of home sales. Tension has grown in recent years between the speculators and aspiring landlords.
Okay. Oh, my head's going to explode on that. So let's talk about all this stuff. So this is the free press that is talking about that. You see this. You can't see because my head's right in the way, but you see right down in the corner says the free press. They've got roughly 400,000 subscribers. So it's not a small. I try not to uh, use guys like me. Kirsten and I have less than 500 subscribers, so it's not like we move the needle on news or anything. But we try to stick with people who have hundreds of thousands or millions of subscribers when they put this out there because they're propagating stuff at that point. So she said a couple of things. Number one, that investors were buying 25% of the in rental inventory. If you look at my last podcast, the episode number one, we went into that. How much do they actually buy? And at the peak, which was in first quarter 22, I think they bought. Sorry, I think they bought 3%, not 25%. But the reason that 25% number comes out is that people look at the units sold. The institutional guys will sell blocks of homes between each other. Invitational call up Meritage or some of the other guys, American Homes, and there's like 6 or 7 really big ones. And they say, hey, you know what? I want to shed these 500. I want to shed these thousands. In the first 6 months of 2025, the big institutionals, the Big 12, they actually sold more homes than they bought. Doesn't sound inflationary to me, and it doesn't sound like a problem for most retail buyers. But all right, so we're talking about this. Institutional guys aren't buying that much. It's BS. He's not fixing anything. It's not affecting anything. And the two things that it will affect on the executive order, just to wrap this whole thing up, is you're going to see more build to rent, which is great, I think, honestly. You have entire communities designed for tenants. They'll be able to get master plan communities where, it has all the amenities that, a Legacy here in Treasure Valley or, on the small side, Heritage Common, big side, Legacy or Terra View. They're not going to be at that luxury level for a spur wing with a small golf course, but you'll get good master plan communities and you'll get the amenities that you usually don't get unless you either buy or you rent in a home when it comes up in one of the nice master plan communities. But this way, an entire community gets built. And if it's big enough, I mean, it won't happen here in Treasure Valley with giant ones, but you go down to Phoenix, Dallas, Houston, Orlando, Jacksonville, where they do build really huge BTR communities. At that point, now you're influencing schools, you're influencing a lot of local politics, even. So I see that as a net benefit, number one. Number two, I see it as disinflationary in that you're putting more rental stock on the market that will keep rents in control, if not actually bring them down. So, again, one tip to renters for the tenants that are watching this: if you want the best deals you can get, move. All right, move to a different place. And I know that costs money, and I know it's a huge pain in the ass. But existing rents are the ones that are keeping the rental number positive. New rents, ask what they call asking rents. They've been contracting for over a year now, nationally. Even here in the Treasure Valley, we had a ton of new construction rental units come on the market in the last 18 months. I think it's over 1,000 total, which, in Boise, Meridian, and then you get in Canyon County down by Nampa and Caldwell. So if you want to get the best deal, move to a new one because we're starting to see 1 month free or lower deposit or whatever. Whereas if you stay in your same unit, they're going to renew it and it's going to be a 5 or 6% increase in your rent. That renewal rents being positive in the 5 and 6% range is what's keeping the national rents in the 1.5 to 2% range. If everybody moved and only got the new asking rents, you'd save, it would be a net negative number, and you'd say, not, if you're going to pay a 6%, say 5%, if you're going to pay a 5% increase, but if you move to a new unit, you actually pay 5 or 6% less, you've got a 10 or 11% savings there. So something to look at if you're a tenant. Move to a new place, get the new rent fees. They're lower than your renewal rates will be in almost every case. So there you have it. All right. So overall, BTR is good for the rental market. It'll bring rents down, give nicer communities. All in all, be a better quality of life for people who are tenants right now and can't afford to buy. So that's a good thing. All right, so I think we've wrapped everything up there. Let me just double check one last time. Yes, that was the BS thing that it was going to change the market if he did the executive order. It's not changing anything. So thank you for watching. If you love it, it's subscribe. Unless you're a realtor, please don't. No realtor subscribe. It screws up the algorithm because you're not looking the same way a buyer looks for this. But if you're a buyer, please subscribe to the channel because it helps our algorithm get pushed out in front of other buyers. And that's what we love. We'd also love to hear from you. What topics do you want to hear about? Drop a comment down below. Tell me what you want us to talk about. We'll talk about it. We'll research it and we'll get you answers. Thank you for watching. We look forward to seeing you soon. Thanks so much. Thanks for listening to today's episode. If you would like more info on how we provide concierge service to our sellers, buyers, and investors, give us a call at 208-872-8108 or send an email to sold@thepowellgroup.re.com. We don't just help people with homes and investment properties, we know land as well. With hundreds of satisfied clients and over 4 decades of experience, our team will help you move on with your life in no time. You can also find us all over the web and social media. Just remember that it's MoveMe, the number 2, Idaho, when you are looking us up. Thanks again for listening. We'll see you next time.